Every audit team has a hierarchy that is followed when we're assigning responsibilities throughout the audit. And it's especially important that throughout the engagement, that members higher on the team review the work of those kind of farther down in the hierarchy. Remember that we want to have professional skepticism. So those individuals with more experience typically want to oversee the work of those with less experience, because those with lesser experience might be more liable to fall susceptible to biases, and also they just have less experience in general to draw from when they're performing their audit procedures. So notice here at the bottom of the hierarchy, we have staff associates, typically with 0 to 3 years experience. So a lot of times students will come straight out of college with their accounting degree, get hired by a CPA firm, and this is kind of the role that you'd find yourself in initially. And they're doing a lot of the detailed testing of accounts. So they're doing a lot of the legwork going into the audit, and basically the senior in charge kind of oversees their work, kind of helps them with the process of conducting the audit. We can see the manager here, they have 6 to 10 years experience. They're kind of a little bit higher up in the chain, so they oversee the work of the senior in charge. And then the partner kind of sits on top of this pyramid. They have the responsibility for making all the audit decisions. Ultimately, they are responsible for producing the final audit report. So these various team members have different responsibilities. As we move forward throughout the course, we're going to talk about, in particular, especially the responsibilities associated with staff and associates, but we're going to talk about the different responsibilities of all these different team members. Now, audit evidence is not only produced by the audit team, but we could rely on outside parties as well to help us accumulate that evidence. So in some instances, we're going to have to rely on the work of an audit specialist for scenarios where we don't have the proper experience to accurately validate the assertions made by management. For instance, if we're dealing with a company that mines different types of minerals, they're going to have an assertion on their balance sheet for their inventory. Basically, if they have deposits of gold or silver, whatever it is that they're mining, right, that's going to be kind of like their inventory item. And, as the auditor, we have to be able to understand the valuation assertion. We have to be able to understand the existence and completion assertion. So we might not have the technical know-how to be able to gauge how much silver is left in a silver mine. So we'd bring in maybe a geologist to help us out with that. That geologist would be the audit specialist in that case. So when we're bringing in an audit specialist or thinking about bringing in a specialist, we need to consider several different factors. First off, do we actually need this specialist? Is this something we could figure out on our own, or is it beyond our abilities? Then we want to think about the competence of the specialist, and also we want to think about their independence. Do they have any relationship with the company that we're actually auditing? And I also want to point out that there's some specialties within accounting, such as income tax or information technology, that those specialties kind of fall under the umbrella of auditing itself. So if we bring in somebody from our firm that's a specialist in income taxes, maybe they're not part of our audit team per se, they're not necessarily considered a specialist like the geologist is, because that's a specialty within accounting, and us as the CPA firm, we're expected to have access to those types of skills to really kind of focus on specialist needs within accounting, as opposed to, the geologists. We're not expected to be experts in determining how much silver is left in a silver mine again, for example. Now, also a big area of focus, especially in the risk assessment stage for the audit team, is figuring out how much we could rely upon the work of internal auditors. Remember, internal auditors are employees of the company that they actually do audit functions within the company to make sure the numbers presented in the financial statements are accurate. So a lot of times the CPA firm, and we're considered the external auditors as the CPA firm doing the audit, sometimes we could rely on the work of those internal auditors. Two ways we could use their work is to help us gather audit evidence, and also they can provide us with direct assistance under our supervision. So we need to think about the quality of the internal audit function within the company before we go about relying on their work. So we want to ask ourselves, how independent are the internal auditors? Obviously, they're employees of the client, so we can't consider them to be completely independent, but a good internal audit function within a company is supposed to give independence. Even though we can't rely on that 100%, that's the whole purpose of having an internal audit function, to kind of make sure that the accounting structure is being followed, that management is actually following proper principles and following internal controls. So these internal auditors, their whole job is to kind of double check the work of management and the accounting department. So they are independent in spirit typically, but there's some factors that maybe give us more verification, or maybe allow us to have more reliance on the work of internal auditors than other situations. So you can note here some of those factors that we look at. There's two broad categories: factors that impact objectivity, and then factors that impact competence. Right? So basically, if the internal auditors report directly to the board of directors or the audit committee, right, that's seen as a very positive sign to us as the external auditor. If we know they're directly reporting to the board of directors, let's say, that means they're bypassing levels of management, as opposed to if they were reporting to the CFO or the controller. If that was the case, if they're actually reporting to the people who are directly producing the financial information, that could lead to kind of a conflict of interest. So other factors here, for instance, internal auditors, if they're a member of a professional body dealing with internal audit, for instance, the CIA certified internal auditors, if the internal auditors at the company have that CIA designation, all right, that gives us greater confidence in their ability to maintain objectivity when they're conducting their internal audit function. Also, we want to think about the competence of these internal auditors. So on the one hand, we're worried about, are they independent and objective? They may be objective, but if they don't have proper experience, if they don't have proper training, they may not necessarily be competent. So if we're thinking of relying on their work when we're actually conducting the audit, all right, we have to take both of these factors into account. Now, if we do decide that, yes, they are objective, we have a high level of confidence that they're objective, and we also feel like they're competent, then we could actually get some direct assistance from the internal auditors. Now, typically, we're going to use the internal auditors when we're working with accounts that we feel don't have as great of a risk of material misstatement. Even if we trust these internal auditors, think they're objective and competent and can do a good job, we still want to rely more on our own work in the audit when we're dealing with accounts that are more susceptible to material misstatements, like the revenue accounts, like accounts receivable. So we may rely on internal auditors, for instance, when we're analyzing like prepaid accounts, prepaid insurance, for instance. There's less likelihood that there's going to be material misstatements with an account like that. So we're more likely to rely on their work with an account like that as opposed to the revenue account. And ultimately, the external auditors, it's their responsibility to express an opinion on the fair presentation of the financial statement. So even though we're relying on the work of these other auditors, the internal auditors, it's still our responsibility as the CPA firm, the external auditor, to come up with that opinion on the financial statements. Now, one other area where we may need to rely on the work of outside auditors is when we're doing an audit of a consolidated entity. So maybe we got hired to do an audit of a company that has subsidiaries. Maybe the subsidiaries are located all across the world. So it may be that other auditors are doing the audit of some of the subsidiaries, and we need to rely on their work when giving an opinion for the company as a whole. So if we're actually the auditor auditing the company as a whole, we're called the group engagement partner. And so we could rely in that case on some of the work done by the other auditors. Basically, it's kind of like a team approach in that case. But if we are the group engagement partner, we should audit the majority of the client's financial statements. So maybe we kind of subcontract some of the audit work out to other auditors working on the subsidiaries in this case, but ultimately, as the group engagement partner, we need to be auditing the majority of the financial statements. So those are a couple different outside entities that we can rely upon. Again, the internal auditors, specialists, and work of outside CPA firms dealing with a group engagement effort. So we want to keep in mind, regardless of which of these entities we're relying on, we want to think about their competence and objectivity, because ultimately, again, it is our responsibility for the final opinion. So we want to really carefully document our efforts to make sure that any work we rely on from others, all right, has been done in an efficient and objective manner.